The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, on Thursday, we saw grain markets that had a little bit of green on the screen. Felt like a quiet day overall. I know corn export sales for the week were pretty solid. Wheat was really kind of the upside leader on Thursday. But again, it was mild gains. Cattle futures rebounded as well. Had some mixed activity in the outside markets. Stocks were up a bit. We've had some inflation data out this week. We're watching the weather. There's a lot of things at play. Let's talk about it. Joining us here on Market Talk, Sean Hackett with Hackett Financial Advisors. Sean, it's good to catch up with you. Thanks for joining us here on the show.
Always glad to be on your show, Jesse. Glad to be here.
Well, let's start with the grains. And I think a good spot for us to maybe kick this off is looking at the weather side of this, because it feels to me, we had the WASDE Tuesday, didn't really give us a whole lot of changing information, and we kind of digested it. We've been digesting tariffs, all this stuff. It just feels like these markets are at the point where the conversation has to shift back to weather. South America, maybe even U.S. weather here, Sean. I don't know. What do you think about this? Is that kind of where the grain markets are at right now?
Yeah, I really think we're totally being weather driven, and based upon the planting season that we're going to be coming up with. What kind of weather are we going to go into that? And of course, second crop corn in Brazil, the big crop that Brazil produces. They're planting it right now. They need a big second crop corn crop after last year's poor crop, and given the tight supplies in the U.S. So yeah, weather's really, really important, and it's starting to show some concerning trends. That might be the next driver in the market, given that we've been lacking some direction here lately.
Let's lean into that a little bit. I mean, what are some of the trends that are showing up? Is it corn? Is it soybeans? I feel like I've been seeing some more red flags on the soy side versus corn. But then, too, I think about that spring acreage mix. Seems like we're buying a lot of corn acres right now, too. So, I mean, walk us through this a little bit more. What are some of the things you're seeing as far as trends right now?
Well, we're harvesting the soybeans in Brazil, so now it's just a matter of who can count the beans correctly. But for second crop corn, we have a situation where the Central Pacific is cold, La Nina. We know we've heard this term before, but the Eastern Pacific is very warm. It's 1 degree warmer. They call it a La Nina Modica. It's one of the strongest one of these we've seen in 40 years. And when you get that combination, it's very strongly teleconnected to a dry central north, central west Brazil weather pattern going into the spring. We've really started to see that happen. In fact, since mid-January to now, and if the weather models are correct going into March, it'd be the second driest period for this time of the year in 40 years. So that's obviously very concerning, especially if it persists into April, which is where the corn crop pollinates in Brazil. And that could really be a big market mover as we get closer to the latter part of March. In terms of U.S. planting, absolutely agree. Everyone I'm talking to, all the seed dealers I'm speaking with, are suggesting that the U.S. farmer is getting ready to plant an enormous amount of corn acres. The problem that I have is I don't think we're going to have the weather in place to do it. And the reason for that is we have something developing called a sudden stratospheric warming event, where the atmosphere over the North Pole gets super warm. And when you get that destabilization in the polar vortex, about 45 days later is when you get that destabilization to connect with a cold, wintry pattern for the Midwest. And so if you work this through mid-April to mid-May, we have a scenario where we could have a very, very cold spring, a chance for a hard freeze, and the chance for a late season blizzard in the central northern plains. We haven't had a setup of this. In fact, this sudden stratospheric warming event is the strongest we've seen. I went back 50 years. I couldn't find a stronger one. So if that's the case, Jesse, we may want to plant the largest number of corn acres, but we're not going to be able to do it with a soil temperature that's going to be well below 45 degrees in many of the areas, and the potential for snow and frost to delay plantings. It's not likely going to happen. So that's kind of the yin and the yang that I see happening here, based upon the idea of large acres, but those large acres not likely getting planted.
Very interesting. And that makes me think about this here as we think about risk management in corn. Of obviously, risk of trading futures and options can be substantial. Always want to remind folks of that. But I mean, you look at D's corn, kind of that 470 mark. I know we're setting crop insurance price right now, et cetera, but just thinking about where the price is at, some folks might not love it, but it just seems like a pertinent level to get some risk management going, Sean, with what you're talking about in mind in terms of weather. I mean, what do you think about the risk management side here for corn?
We've been very clear to our customers, and even when we're speaking at the conferences we speak at, that our strategy here is to reward the old crop corn price with supplies. I mean, we're up over $1.20 from the lows. I mean, farmers need to raise cash, they need to pay bills, they need to make the bankers happy. We're absolutely encouraging farmers to take advantage of that cash price. We're discouraging, however, them making significant forward cash sales for the new crop. We would prefer to lay floors under the market in December corn to protect against black swan events, which we know are always out there, especially with the Trump administration and just all the things that are happening in the world. We think that's a solid way to manage risk, but we don't want to get farmers locked into making a cash sale that is either too great as a percentage of the crop if they have a poor crop, or it's just done way too low considering all the weather risks that we see going forward. We think that's a much better way to manage risk on the farm and gear yourself to keeping your top side open with where we think there's some pretty significant upside price risks that farmers would want to take advantage of in the months to come. So that's how we think is the best way to manage it right now.
It's an interesting perspective and a way to look at it. I think when you think about the soy conversation going over there, it's a totally different conversation. I mean, we got a glut of soybeans in the world. You were talking about the South American harvest earlier and a price in soybeans that I know a lot of folks really don't like, even though we've seen a pretty substantial rally here in the last month. But it just seems like the soy fundamentals are way different, at least in my view, than the corn fundamentals right now.
Well, we view corn and wheat fundamentals. We have very constructive fundamentals on both. Very constructive fundamentals on both. We do not have constructive fundamentals on soybeans. Let's just be very quite clear. We do not have it. Now, if corn and wheat have big surges on frost or drought or delayed planting, it doesn't mean soybeans are going to go down, right? I mean, if we put $1 on the corn market and $2 on the soybean market, on the wheat market, like we did last year, they're going to drag the soybean market up by its bootstraps because that's just what happens. But understand that it is definitely an inferior market fundamentally, and you want to be more careful on the soybean market because of that, and you want to be much more willing to reward rallies because of that, while keeping more of the top side geared towards wheat upside and corn upside. That's really the way to play it, where we see the fundamental modulus of elasticity towards corn and wheat being more fundamentally bullish, where soybeans, you'd really have to count on wheat and corn to give yourself a better price.
And then soy products too. I don't see a lot of support there. I mean, whether you're looking at meal or oil, it seems like both those markets have lost some of their shine and luster as of late as well, Sean.
Well, the first thing we have to do is we have to clear up what are the rules of engagement for renewable diesel going to be going forward. What are they? We don't really know. Is RFK going to tell us, soybean oil and food is going to be banned? I don't know, but I mean, it's a huge factor in what the crush is going to be needed, and it's just too many unknowns in the derivative products, Jesse. That we just need some clarity. Doesn't mean we won't get the clarity, but yeah, you're right. We're just in markets that are so opaque right now that the market is just continues to be two-sided, back and forth, waiting to see if we can figure out what a pathway forward really looks like. Eventually, Trump and his administration will provide that, but it may take until midsummer before we get that.
Sean Hackett with Hackett Financial Advisors joins us here today on Market Talk. Let's go over to the livestock trade, Sean. Cattle futures, decent rebound Thursday. We had some tough days last week and early this week. Futures kind of pulling back substantially. Cash has moved lower this week. I feel like some folks have been getting nervous in these cattle markets. But I wonder, maybe here towards the end of the week, are we trying to find some technical footing and stabilize a little bit, at least on the future side? What do you think, Sean?
the price is high. We know this. The beef cutout price is high, showing that there's still not enough supply with demand that's out there. The way I'm looking at it is my view on the ground is that we're starting to finally see heifer retention from the customers I talk to and trust. We know heifer retention and herd rebuilding means we're going to tighten up the supply even further, especially in the back half of the year. It is hard to see a significant decline in price unless we go into a major economic recession like 08, 09, or the pandemic. You'd have to have a real significant economic shortfall in order for that type of tight supply to not at least support the market here at current prices. When you think about our weather forecast, a cold spring would actually be somewhat constructive for tightening up beef supplies a little further into the spring. But, and the big but, and this is where we come in at, is that a hot, dry summer in the areas of the country where cattle are concentrated, which we think that there's a higher order risk this year, would quickly reverse those trends and create another round of herd liquidation. So I think what I'm saying with all of this, I think we're going to have a sideways volatile trade. I know that sounds like a cop-out, but I really believe that's what we're looking at. A sideways volatile trade, potentially a spike into the winter, into the spring, a fall off on a drought in the summer, and then a reignition of a rally into the fall as this herd liquidation stops and we have even less animals for sale. So I think as a producer, you just need to be opportunistic to sell times when the market spikes higher, like we just saw recently. And on the buy side, you need to be opportunistic when the market kind of caves in for a little while on spec selling and maybe some herd liquidation. That's really what I see for the cattle market into the end of the year, an opportunistic sideways trading market.
And I'll piggyback with you on this. I've been talking about this for quite some time and kind of screaming from the rooftops, so to speak, that at these price levels, if producers are not managing their risk effectively in this cattle market, you're playing with fire at this point. Because, I mean, funds have a really long position as well. And if they decide they want to get out, I mean, next thing you know, we could be down $30. I mean, it's one of those things where pertinent risk management is going to win out here in a cattle market like this one, Sean. It's just that's my view. Yeah,
absolutely. I mean, look at the feeder cow market. You have LRP that you can put under the market. It's a subsidized, it's a subsidized put program that the government has that you can put a floor into the market, take that risk off, keep it topside open in case I'm right about a rally or whatever. But I mean, things like that to me, with the money as big as it is on the table right now, that's what I'd be doing, and that's what we're yelling from the rooftops for our customers to be considering. Can't make anybody do anything, but that's our recommendation. So,
any other markets you're watching? I know we've seen plenty of action in things like coffee and gold and you name it, and watching the cotton market. That's kind of felt like that's been down a little bit. You look at dairy markets, the broader inflation data that's out there we're getting this week. There's a lot of things going on. I guess any other key markets you're keeping an eye on here this week, Sean?
I think a really key market, not only because it's a big market for the U.S., but also I think it gives a good read on China-U.S. relations, China economy, is the cotton market, because the cotton market, most ag markets in reality do not have much cyclicality to their demand, but cotton does. And we know that if we don't sell cotton to the Chinese, we're not going to have a good cotton price. I mean, it's a really big market for selling a high quality cotton to the Chinese. And so all the stimulus that the Chinese are putting in place and the money printing and trying to promote better consumer behavior and negotiations that might start happening between China and the United States, given that we've all put some tit for tat tariffs on each other to kind of get the ball rolling. Cotton really, to me, if you've been watching the chart, it's just been sitting here just listless. I call it the EKG of a rock. And normally when markets get this quiet, old time traders said you never want to short a quiet market. I would really be watching the cotton market if it comes to life and starts to to show that it's moving higher, or we start to see some larger weekly exports from the U.S., which we've been starting to see, that would really, really be a kind of a leading indicator to some better times ahead for grain demand and maybe some better relations with China, which of course is very important for the overall commodity trade.
Great thoughts there. Anything final you would mention or reiterate to folks as we close out things here today on the show?
Well, I think we have to be excited by the idea that volatility has come back to our markets. And what I mean by that is that the last 18 months have been pretty depressing. We have not had a lot of volatility. We've had markets that have been just sort of listless, eroding away, not providing a lot of opportunity in aggregate. But we're starting to see things change with that. We're starting to see markets moving around more. And that is always a better opportunity for producers to bring more money home in the farm if they're proactive with their hedging and cash marketing and risk management. And so if I could leave you with that idea of being proactive this year, there's going to be a lot more opportunities to do stuff than we've seen for the last 18 months. In my view, that's a good thing for a better farm economy in the U.S.
Sean, if folks want to reach out, have a conversation with you there at Hackett Financial Advisors, I know a few ways to get in touch. How could folks reach you?
One place is our website, Hackett, Hackett, advisors.com. Another place is our Twitter page at Baradex11. We don't sit at the computer putting stuff on social media constantly, but every once in a while we'll put some tidbits on there about how we look at the ag markets with our statistics, cycles, and correlations. And hopefully going to those places might help those that watch your show have a better look at what might lie ahead in the ag economy.
HackettAdvisors.com, and I will echo the sentiments on the X account. Always some really good nuggets there when you guys post stuff. So appreciate the time. Sean Hackett, Hackett Financial Advisors, thanks for being with us on Market Talk. Have a great weekend ahead, and we'll talk to you again real soon.
Thanks, Jesse. You too.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.